This video gives you an overview of the financial services industry. Share this video with friends and family, hit the like button, subscribe. Let's get into the video. Microsoft Word is the fifth thing on my taskbar. To open it, press Windows key 5. When you get to this menu, press Enter. Alt F4 to close that. Control E as in Echo. Control B as in Bravo, U as in Uniform to bold and underline. I'll say Financial Services Industry Overview. Alt N is in November. N is in November, U is in Uniform, B is in Bravo to add page numbers. Alt J is in Juliet, H is in Hotel, C is in Charlie to close that. And then I have on my quick access toolbar the bullet points option, so I can press Alt 5 to play. Alright, so there's 4 key buckets for the financial services industry. Depositories, specialty finance, FinTam, which is fintech, and asset management, and then broker, dealers, and exchanges. And let's do function menu key to fix that error. And spell check, things are looking good. Alright, so the depositories consist of 2 businesses, mainly, right? There's banks and insurance underwriters. Specialty finance, that's your non-bank mortgage lenders, SPACs, special, that stands for special purpose acquisition companies, REITs, which is real estate investment trusts. And you also have things like non-bank credit card issuers. And FinTam is, of course, financial technology companies. And then asset managers themselves. Right, and then this is the final group, broker dealers and exchanges. And we'll add, market makers, which is a type of dealer. Alright, so the thing about depositories that's important to know is they are balance sheet businesses. The balance sheet drives the income statement and not the other way around. So banks, what do? They borrow at a low interest rate and lend at a higher interest rate. Insurance underwriters, they collect premiums for underwriting risk and invest those premiums. The key thing to know here is, let's think about sort of your unlevered free cash flow formula, which is EBIT times 1 minus tax rate plus depreciation and amortization minus CapEx minus, let's see if I can find the delta symbol, change in WC, which is working capital. So unlevered free cash flow is not going to work for these businesses, and sort of the reason why is, first, banks earn interest as part of their top line, and same with insurance companies, they're earning interest on their assets, so there's no such thing as earnings before interest and tax. Banks and insurance companies don't have a lot of depreciation because they don't have a lot of property, plant, and equipment, so that's not going to get it done. CapEx does not represent reinvestment in the banking business or the insurance business. Reinvestment in regulatory capital does. And finally, working capital is not the right liquidity metric for a bank or an insurance company. Working capital, which is the difference between current assets and current liabilities, doesn't work because banks and insurance companies, there's cash flowing in and out every single day, and it's too volatile to be a good liquidity metric for these businesses. So the solution here for valuation, right, is the one option is the dividend discount model, and I'll fix that. Actually, that appears to be spelled correctly. Dividend. And it's important to back the dividends out of the model when you're doing a dividend discount model for depositories, because they have regulatory capital requirements. So in your forecasting, you have to back the dividends out of the model as opposed to blindly assuming a dividend growth rate. That way you don't make the erroneous assumption that they're going to pay dividends out in excess of that cause them to breach their regulatory capital minimums. If a bank or an insurance company has regulatory capital that falls below its minimum requirement, dividends and bonuses are automatically suspended by the regulators, and that's not very good. So another option is levered free cash flow model, but you're going to redefine it as net income minus reinvestment in regulatory capital. I'll fix that. So that's another option. When you're dealing with levered free cash flows, discount at the cost of equity. Another option is excess return model. And that is the book value of equity, right? Let me fix that. Make those capital. Plus present value of future excess returns. Alright, so those are some of the options. In terms of multiples, you look at price to book value, P to tangible book value, and price to earnings. So that's sort of your depositories. Now we'll move on to specialty finance. And so SPACs, real estate investment trusts, non-bank credit card issuers. A lot of these types of companies you can use the dividend discount model for. These are businesses that basically lend money or provide capital, but they're not banks and they're not insurance companies, so they don't underwrite risk and they don't take in deposits. Some of these have some special metrics, such as real estate investment trusts. You look at price to funds from operation, price to adjusted funds from operation. Those are some metrics you look at. And then you have FinTam, which is FinTech and Asset Management. These are EBITDA-based businesses. So you can value these. Obviously, the asset managers collect fees, and the fintech companies they either lend money themselves or they provide hardware and software that's used by the other financial institutions. So you can value these with your traditional unlevered DCF, right? And then your multiples that you look at. So you look at enterprise value to EBITDA. And then in the case of asset managers, enterprise value to assets under management, enterprise value to fee-paying assets under management. The reason for that is sometimes the founder has a large amount of their own net worth in the fund. It could be a large percentage of the assets, and maybe they don't charge themselves a fee. Some general partners, founders of these funds, invest on the same terms as their limited partners, and some do not, but maybe you want to look at enterprise value to fee-paying assets under management as well. And then finally, you have broker-dealers and exchanges. You can look at different multiples for these. So you can look at EV to sales, enterprise value to EBITDA, etc. Some of the more traditional multiples. And then broker is an agent acting on behalf of a client for a commission. And a dealer is a principal acting on behalf of his/herself to earn a spread or buy low and sell high. So these are sort of the four buckets of the financial services industry, the four verticals: depositories, specialty finance, fintech and asset management, which is abbreviated as FinTam, and then the broker-dealers and exchanges. The most unique from a valuation perspective is depositories, and then the most that are like the group that's most like normal businesses is your FinTam, your fintech and asset management. Take this knowledge into the marketplace to be a better investor and better understand the financial services industry. Have a great day. Thank you for watching this video. Please subscribe to my YouTube channel, hit the notification bell, hit the like button, leave a comment below, and please buy my books. The links to those will be in the description of this video.